Welcome to the Living in South Louisiana podcast. I've got my buddy Stephen Rapalo here, and we're going to be talking about investing in real estate. Stephen is a mortgage broker, and he's got all the knowledge you need on loans for investing in real estate. Okay, so we're going to talk about how you can use real estate and leverage that to build a portfolio and actually use that for financial freedom, use that for passive income and retire and live off your real estate portfolio. And to do that, you're going to need to know a little bit about loans. So you can't just start buying real estate. You got to know how much you're putting down. You got to know how to qualify for those loans. You got to know all the numbers. So we're going to get all into that today in this podcast. So without further ado, we're going to start off with Stephen. So if you would just introduce yourself, give maybe a brief life story of Stephen. And let's kick it off.
Awesome. How you doing, guys? My name is Stephen Rapalo. I work with Reliant Mortgage, part of the Rapalo mortgage team. And so, like he was explaining, a big thing we want to focus on today is investing. But before we get into all that, a little background on myself. My family has been in the mortgage business as long as I can remember. They started a business in 2001. So before I even knew what work was, where they were going, I was, crawled up underneath a loan officer's desk, hearing all the lingo. And I like to think of it as I didn't choose mortgages, mortgages chose me. Just everyone I was surrounded with has always just kind of been a part of my life. So I've been in it for 4 years, seen the broker side, the lender side, seen the ups and the downs. And without a doubt, I think we're in the most interesting time of the market for most people our age. So one of the biggest things we want to focus on today is how to invest for y'all's future, invest for that financial freedom.
Yeah. Should I be worrying about interest rates if I'm an investor? I'm just going to throw that question at you. Should I be worried about it? Should I just not buy? Should I wait for interest rates to drop? What's your opinion?
So that is definitely a buy loan basis, or an individual investor and an individual property. So, if you're able to go in and get a property at a great deal that you don't believe that you may be able to get in a year or two from now, jump on it. If it's going to, create cash flow for you now, do it.
I would say my thing is don't buy a property unless you're going to cash flow. Interest rates matter, but they only matter when you're not cash flowing. If you don't cash flow, you're gonna. In 2008, there's many reasons why people lost their homes, but a lot of investors were buying homes for speculation. They were just buying mainly for appreciation and not keeping cash flow in mind. And whenever the market crashed, well, all their equity demolished. So they lost their real estate investments that way. So if they had leveraged cash flow, if they had some cash flow, even if it's $100, $200 a month after you account for property management and deferred maintenance, capital expenditures, if you've got a little bit of money coming in each month, that serves as your hedge against a real estate market crash. So I would say, in my opinion, and I'm sure you would agree, that it's still a good idea to buy real estate at any time as long as you can cash flow. If you can't cash flow, it's more of a risk. It's more of a liability, I think, if you're not cash flowing than it is an asset. So make sure you're cash flowing.
Definitely. So, and actually, while you're on that, speaking of a liability versus an asset, the past year I've kind of been really digging into Rich Dad Poor Dad book.
Yeah.
And so I've been owning a home with my wife for about 5 years now, and for the longest time thought, hey, I've got an asset, and without realizing, no, it's a liability. If it's not producing cash flow for you, it is not an investment or an asset. It is truly a liability for you. But before we move on from that, it is a great stepping stone, a great opportunity for someone to become an investor or to create an asset. Get into a home, very low down payment, really good interest rate, keep your liability low, your monthly payment low, and then when you're ready to purchase that next home, boom, you automatically have an investment property.
I think of a personal home almost like a savings account.
For
You know
sure.
what I mean?
Definitely.
Because usually you break even. You can profit if you time the market pretty well. I mean, not necessarily timing it, but if you like Natalie, for instance, my girlfriend, she bought her home in 2020 for $250,000, and it's worth about 310 to 315 after just 2.5 years.
Yeah.
So she's gonna profit. Like she's going to, if you account for all the money she put into her mortgage and her utilities, everything that she put into the house, including her down payment because it was FHA, she's still like barely profiting. But so if she would have rode that for another 10, 20 years, she might have profited. But I think I agree with that. It's not an asset unless it's producing cash flow. It's the opposite of cash flow because you're out money each month.
Yeah.
But the good thing about owning the home versus renting is that renting is essentially throwing the money away, and a mortgage is keeping the money, but it just takes time to get the money back. You know what I mean?
For sure. Consider your home another 401k.
Yes, that's a good
it's another retirement account, and while you're paying down your liability, it's also appreciating at the same time. So every month you're putting in, and it also appreciates.
Difference between that and what makes an investment an actual an asset is you're not even the one paying down the debt. Your tenant is paying down your debt for you. Hence why it is then an asset, not a liability, and it produces cash flow, or it should. That's why I said, like I said, interest rates matter, but they only matter if you're not cash flowing. So in this market, you just have to find a better deal. That's what it comes down to.
For sure, absolutely.
Yeah. So did you want to finish telling them about you? Anything else you wanted to bring up, or?
I mean, I'm not super interesting. I'm a short Hispanic loan officer that knows a bunch. So if you got questions, always happy to help answer them.
Yeah, we're gonna put everything down in the description. We'll put your website and your contact info down there, so where they can find you. But I guess just for people listening, what is the difference between an actual mortgage lender, a mortgage broker, a loan officer, or a processor?
For sure.
Like I feel like there's multiple people you have to talk to. So I just for the people listening, could you just explain different positions? And you're a mortgage broker, is that right?
Correct.
Right. So so go through the different positions if you would, so they have a better understanding.
Yeah, absolutely. So technically, if you wanted to call me a mortgage lender, I help lend money. But the difference between a mortgage broker and a mortgage lender, they're both licensed loan officers. So we're both loan officers. The difference is a lender or a loan officer that works for a lender specifically, is they are tied down to that lender's one specific loan products, their interest rates, whatever that lender offers. As a broker, we're able to go and shop, 15 to 20, sometimes even hundreds of different loan options, loan products, different rates to make sure that you're getting the absolute best product and rate on the market. And then also processors are the back end. They're the ones who, once the file comes in, once it's under contract and you're getting conditions and you're getting appraisal ordered and insurance and title work, they're the ones that kind of help tie everything together and make it a lot less painful for everybody else.
They do the important work. So Natalie is essentially, I guess we don't really have processors, we have transaction coordinators on my side of the business. So that's basically what Natalie is. So I'm the one that's going out and getting all the leads, and I'm the one, I'm the business generator, and then she does what I just call the important stuff. Like I'm just the show. Like I'm the one on social media, I'm the one going out and getting clients. And then Natalie just takes care of like the stuff I don't want to do. She's like emailing back and forth with title companies and you guys, the lenders, and oh my gosh, the inspection responses, and she does all the hard work. I would say. And I'm out here, I'm the showman.
Just smile and wave, boys.
Yeah, that's my job. We're a good team, but so that's what a processor is. Okay, so I guess the benefit you would say of working with a broker over a lender is lenders don't have very many options, whereas brokers have seemingly unlimited options. Like you can just go around to different lenders who might offer a better rate or better terms or what have you, and lenders not so much. They've only got a few products they can use at one time.
Exactly. So, you might find a lender who focuses primarily on first-time home buyers, or maybe focuses just on investments, and they don't have everything in-house. But as a broker, we're set up with all those lenders to make sure we're able to offer all those products under one roof. And also we know how to make things work too. So if it's not working one certain way, we can take that file and send it to another lender that can make it work.
Okay, I got you. All right, so let's talk about investing. So there's a few different loans that people are already familiar with. Most of the time, I don't know if it's most of the time. I'm assuming that most of the time, homes are bought with either FHA or conventional. Is that right?
I'd say those are definitely the two primary.
For a personal residence, you're usually either using FHA or conventional, and it is mortgage fraud to buy a rental property with FHA. Is that right?
Technically correct.
But you can buy one and then move out after a certain amount of time.
After 1 year, you have to live in the home for 1 year with an FHA loan, and then you can rent it out.
So technically, if I was say 21 years old and I've got a W-2 job and I'm saving up 3.5% down from a first property, I can buy a property. Let's say it's $200,000. That'd be like $7,000 that I've got to come to for down payment purposes. So I can essentially get in, if we negotiate closing costs out, to my first home for $200,000 at 21 years old, for $7,000 for a $200,000 house at 21 years old. And then say when I'm 22, I can have another $7,000 saved and then go buy another house and then start renting that one out. And then I can do the same thing every year, right?
Yes. I believe the max is you can have 4 FHA loans at a time. So you can.
So you'd have to refinance after 4 into a conventional.
Or just we'll get into the other products that you can refinance into as well. But yes, DSCR loans or some non-QM products that we can make work for you.
Okay, so if you're trying to get started with very little money, I would say that might end up being the best option. You might just buy a property and have to live in it for a year or so, move out and turn it into a rental. And what you also can do is, correct me if I'm wrong here, but up to 4 units you can buy with an FHA loan if you live in 1 unit. So if I was going to go buy a 4-plex in, say, Hammonds, or they have a few in Slidell, Baton Rouge, New Orleans definitely, but if I was going to go buy a 4-plex, I could live in one of the units and rent 3 of the units out, and depending on your insurance and interest rate, you might end up being able to actually cash flow as if you had bought a rental in some cases. So is that right? You can buy a 4-plex with FHA, but no higher?
Absolutely. So FHA is the only loan program that does not increase the down payment requirement when you're over 1 unit. So FHA 1 to 4 units, still 3.5% down, which is incredible. Especially with the market that we're in. You can get, like we were saying, you're not even buying a liability at that time. You're buying an asset that's going to create cash flow, and you get to live in it.
So you might just, especially while you're young, you might just want to suck it up and live in a 4-plex or even a duplex or triplex. So you're actually living in an asset versus a liability, like we talked about earlier in the show. So I think that might be a really good first investment. If your main goal is to get in with as little money as possible. Now, if you wanted to start with a little bit more money, maybe you have a little bit more to work with, you're willing to invest a little bit more, or you want a return on your money now versus you might not be able to get consistent cash flow if you were going to use an FHA loan and have to live where you're buying to start off. I would say just going out and buying a duplex or a triplex or a 4-plex, just one in a decent market that you think is going to appreciate decently in the next 5-10 years or so. One that doesn't need a whole lot of work, or maybe it does if you have the money to put into it to fix it up and refinance. You could do that, and we'll talk about that. But if I was going to go out, let's use the same scenario. I like to use like imaginary people when I explain things. So we're just going to say this dude's 21 years old, W-2 job.
Mm-hmm.
He's making $50,000 a year, and he's managed to save up $30,000, which means he could probably buy what can you buy? You could buy $150,000 duplex maybe over in Gonzales. I've seen a few of those.
Yeah. What you're saying, like as an investment with like 20% down?
Correct.
Yes.
Not living in it, just buying it. What kind of loan would you recommend for something like that?
Yeah, for something like that, I mean, it all depends. Like if you're 21 years old and you don't have a place to live, I mean, maybe consider living in one side and renting out the other. But if you're looking to go truly investment, and you do have the income to, to get approved, and you have tenants in the property already to have that extra income, I would definitely look at a conventional loan before looking at any non-QM products. So,
all right. So that's scenario one, and then let me give you another scenario. Let's say I've got 6 rental properties, and I'm 35 years old, and let's say I've retired. Let's say I'm not actually making any earned income anymore, and those 6 properties, maybe I've got some commercial investments and I'm doing pretty well, and I'm making $50,000-$60,000 a year in net cash flow, and that's what I'm living off of. I'm effectively retired off those 6 properties. Okay, so if I was going to go buy something else, I don't really have any W-2 income or even 1099 income. I'm just living off my cash flow. So what do? I want to buy another property, and I've got enough for a down payment. But what are my options at that point? Are there any options?
Yeah, absolutely. So a couple different options you have at that point is to find an investment property you're looking to purchase that you believe will, cover that monthly mortgage payment. So what we would do is we would get an appraisal done on a DSCR loan, which is called a debt service coverage ratio. And as long as the projected rent comes back on that appraisal higher than your monthly payment, you're approved. We don't need to see W-2s. We don't need to see tax returns, no pay stubs. We just need that bank statement showing you've got the money to close.
What about credit?
So credit, they do have credit requirements on those, and you don't want to have below a 680. There are a couple lenders that will do down to a 640, but it is going to be very hard for you to qualify that property because the interest rate is going to be much higher below a 680.
Okay, I got you. All right, so basically, very little documents you would need to bring to the table as long as the rental income is higher than the mortgage amount, then you should be good to go. And so that's not for short-term rentals per se. That's for long-term rentals. So even if I was going to buy a property that I wanted to use to put on Airbnb, it would still have to qualify for the long-term rental, right?
Correct. Yeah.
Okay. So all right, that makes more sense. So I guess if you already have some properties and maybe you're worried about your debt to income ratio, it probably would be better to go with the DSCR. And then if you were starting out, it might make more sense to go conventional as long as you qualified.
Correct.
Is conventional a lower rate?
Yeah, so that's the thing is with conventional, FHA, all of your, opportunities to get into a property, you're going to have a much better interest rate on government-backed loans. And so government-backed loans are RD, USDA, the same thing, 100% financing, VA, FHA, and conventional. So those are the 4 government-backed loans. Anything outside of that is considered a non-qualified mortgage. And that doesn't mean it's a bad thing. What it means is just that the government doesn't back those loans specifically as, you know.
They make it sound bad on purpose, so you use their loans.
Yes.
That's what it is.
But no, there's a bunch of great products. Like I was telling you earlier, on that DSCR program, they actually offer a 40-year loan, the first 10 years being interest only. So you have 10 years to, you know, get into that property, create cash flow for yourself, hopefully be building up some equity.
Yeah.
And whether or not you want it to sell or refinance to a conventional loan once you have income to show from that property, I mean.
Yeah. And interest only is a very low payment, by the way. We're talking serious cash flow, especially if you're doing
Yes.
like an Air BNB, for instance. If you've got 10 years of interest only, and then there's nothing really stopping you from selling after 10 years, huh?
No,
You might just ride the cash flow for 10 years and sell it, and you just made a ton of money.
Absolutely. And so one thing to know about a lot of these DSCR loans is that they do have different prepayment penalty options. So you can pay a certain amount in fees at closing to not have a prepayment penalty, and get that prepayment penalty down to 1 year, or you can get it up to 5. So as long as you're staying in that home, in that property, you know you'll be able to keep it as an investment for at least 5 years. It's a great opportunity.
Yeah. And I would imagine the interest only portion of that loan is going to be a little bit higher interest than the amortized portion, right?
No, I believe
Really?
it's actually going to be your fixed rate.
That's crazy.
But let me double check on that before y'all take that.
Yeah, we'll edit that out if it's not true.
Yeah.
Figure it out. So, but DSCR in general is going to be a little bit higher than a conventional per se.
Yes,
Okay.
absolutely.
Okay, I got you. No, it makes a ton of sense. But I mean, if you're able to do interest only, you're killing the game.
Yeah,
You know.
absolutely.
So, even with long term rental, like that's what I was saying is, a lot of people are worried about interest rates, and the thing with that, if you're buying investment, there's multiple ways that you make money with one investment property or one asset. So there's 4 main ways, which is tax benefits. So you can depreciate the property on your taxes just for tax purposes. I'm not a tax professional, so you got to talk to a CPA about that and they'll explain more. But essentially what depreciation is, it's not actual depreciation in value, but depreciation on paper. You can write off, I believe for a single family rental property, it's like 27 and a half years you can write off the value of the home, not the land, but just the home itself. So usually it comes out to where all your cash flow is essentially tax free because you take that depreciation. So that's one benefit. So you have depreciation, you have debt pay down. Okay, so basically your equity is growing over time, which leads into the third one, which is appreciation. And then you have cash flow. So cash flow is just one of the ways that you make money by buying an asset. You still make money with the other 3 no matter what. Okay, unless you're not able to make your payments, which is why you would want to cash flow, because the cash flow hedges against you losing your property. So again, you're able to take the benefits of depreciation, appreciation, tax benefits, and cash flow. So there's 4 main ways. And then if you are worried about interest rates in today's market, I would tell you 2 things. I would say number 1, remember you can always refinance later when interest rates drop. The issue is you don't know when that's going to be. I don't know when that's going to be. I can guess, but always keep that in mind that even if you buy something that's cash flowing $50 today, at least it's cash flowing. And then maybe when rates drop to 5% and you refinance, maybe you're cash flowing $200-300. So keep that in mind. And then also, what if the way you got around interest rates being high is you just paid interest only for right now and you did a DSCR loan? So those are 2 things I would say to keep in mind if you are indeed worried about. I believe we're still at like 6.5-ish.
Yeah, we're in the 6s for sure.
If you're still worried about that, then that's 2 things that I would keep in mind.
And definitely while we're hitting on interest rates and, you know, kind of being hesitant to buy right now, if you're hesitant to buy because I don't know how high interest rates, are going to get, or I don't know when rates are going to come down. Well, if you can afford it right now, worst case scenario is rates are going to keep going up, and that same house that you're looking at for 250, 300,000 is just going to get more expensive. Best case scenario is in a year from now, rates will drop and you can refinance. But if this is the lowest we're going to see for 1 or 2 years, you want to really keep renting and throwing away every penny for the next 2 years, or build some equity.
Right. And here's the thing: the price of the property that you're buying matters zero. All that matters is your payment, because you have to the metric that most of the real estate investors that I talk to, the main metric that they look at is cash on cash return. So if I put $30,000 into a property, usually I want to make about a 10% return is a decent return. So I want to make $3,000 a year or $250 a month in net cash flow. Okay, so that's your main metric that you should be looking at as an investor. Am I making anywhere from an 8 to 12% return on my cash, on my actual cash into the deal, right? So the price of the home doesn't matter, in my opinion, because what matters is that payment. So that's going to account for insurance, flood insurance as well, your interest rate, your property taxes. For instance, property taxes are literally half of what they are in New Orleans and Hammond, Louisiana. They're half. And same thing in like St. Bernard Parish, for instance. I forget what the actual rate is, but it's almost half of what the property taxes are in New Orleans. So the price doesn't matter, at least not as much as your actual expenses every month, your business expenses, your mortgage, interest, taxes, insurance. Because if we know how much money we're bringing in, that's how we're going to calculate our cash on cash return. And at the end of the day, all that really matters is I'm putting X amount into this property and I want X return. And everything else is just, I don't know. You want to get a good deal, but I don't think the price is what makes the deal. I think the numbers on your spreadsheet is what makes the deal.
Yeah, no, I definitely agree with that.
Yeah. So, all right, so we've talked about that. So you were mentioning strategy that you brought up to me, where I guess you were saying you could buy an Airbnb and then maybe use a DSCR loan and take your interest only, and then basically reinvest that cash flow into the next property. And then maybe, who knows, maybe in 10 years, I'm just guessing, maybe if you buy one property in 10 years that you're doing interest only, I would think you could probably buy 2 or 3 more properties.
Oh,
just riding the cash flow like that, if you reinvested everything. And then you've got 3 or 4 properties that are giving you all those benefits. Remember, it's not just cash flow. You're also riding the appreciation, the depreciation, the tax benefits, the debt pay down, and the cash flow as well. So that's a really good strategy that you brought up to me, and I'll definitely recommend that for people. Here's what I'll say about Airbnbs though. They are being outlawed, the actual short-term rentals, so nightly rentals, in a lot of bigger cities. They're definitely outlawed in Vegas. I think there's a city right next to Vegas where they still do them. I think it's called Hendersonville, maybe, I forget, but they still do them. But Vegas is like, nope, no more short-term rentals. And there's a couple other cities, I believe, that have already started outlawing those short-term rentals. But here's the thing. You can do pretty much anywhere a midterm rental. So 3 to 6 months at a time, you can have your property rented out, and usually you would get about double the amount as your rent as you would with a long-term tenant. So if I had a 6-month lease to, say, a travel nurse, and I had a property next to maybe Children's Hospital, okay, and I had a 6-month lease, I would make about double the rent that I would if I threw a long-term tenant in it. So here's my opinion. If you are looking to get into Airbnb, I would say you'd want to do two things. Number one, make sure that the property you're buying would work as a long-term rental, because that's your worst case. So make sure that if Airbnb got outlawed, that you would be able to make it work for a long-term rental. Even if it's just $50 a month in positive cash flow. As long as you're positive, you're safe, okay? Try out Airbnb. Maybe it works, maybe it doesn't work. If Airbnb doesn't work, there's a website called Furnished Finder, and it's actually for travel nurses. And you'd be surprised the demand for travel nurses. There's so many travel nurses nowadays, and what's cool about those is their companies give them a stipend, so they're not even paying their own rent. The companies they work for pay their rent, so they're paying you. So you can charge a pretty nice amount, and usually the standard market rate is about double what it would be for a long-term rental because it's furnished. So that's another option too. I would say make sure it works as a long-term rental. Try it on Airbnb because you're going to make 3 or 4 times more than you would long-term rental with Airbnb. And then I would say a good idea is to buy within maybe a 15-20 mile radius of a hospital, because if you still wanted that really nice cash flow, instead of your $50 a month long-term rental, if you're next to a hospital, you're able to put it on Furnished Finder and do a midterm rental. So
That's very interesting. I never heard about.
That's the backup plan.
The nurse option.
Yeah.
That's actually
you'd
pretty
be
cool.
surprised. There's so many travel nurses.
Oh no, I actually just did a loan for a travel nurse,
Really?
and she is making a shit ton of money. And
I know. So here's what they do, because remember that, like I told you, they get a stipend for all their
food.
Food. So what they'll do is basically they have no living expenses, essentially, besides like Gucci handbags and stuff.
Yeah.
So they don't have any actual living expenses. They're basically paid to go work, and then they take the money that they normally would use as living expenses, and then they'll save that up and they'll start buying properties.
Yeah.
So
definitely.
it's definitely, if I was a nurse, I would totally do that, because I love traveling. And you're not always going to the best places. Like they might send you to Atlanta,
Yeah.
and then over to Detroit,
Ooh.
and you're just like going places, But I think I would do that if I was a nurse.
Oh, yeah.
Great way to make a lot of money and save up, and then start building wealth from there.
Yeah. No, absolutely.
So it's a good deal. I would do it for sure.
Definitely. And before I forget, I actually do want to go over something with you real quick. I went and looked it up. So, for self-employed home buyers or investors, when we are reviewing your tax returns, the first thing that everybody goes to is your Schedule C, which is your profit and loss from your business. So, it's not how much money you made or how much you got in 1099s. What matters is if you go to your Schedule C and scroll down to line 31, it is your net profit or loss. So we take that line 31, we go and we can actually add back in line 13, which is depreciation. So like you were talking about, writing off that depreciation rate. Yeah. All that stuff is great to write off because it's income we can actually add back to self-employed borrowers. So 31 plus 13, and then on page 2 of your Schedule C, we can actually add back 25 cents per business mile driven. So you did like 30,000 miles. I'm not too good at math off the top of my head like that, but it's $5,000 to $7,000 that we're able to add back to your income.
Nice.
So make sure to include all those things. Don't just go to TurboTax. Get with a professional. And make sure your taxes are done correctly.
Yeah, there's nothing better than an actual tax strategist, a CPA
For sure.
who understands the tax code. Because here's the thing, people that don't understand the economy, people that don't understand money, will say, "I've got to tax the rich, and rich don't pay any taxes, and it's not fair because I pay taxes." But what you don't understand, or what those people don't understand, is the tax code is written in a certain way that anyone can take advantage of it. Like, it's set up in a way that you are incentivized to not pay taxes if you do certain things.
For
so
sure.
if you end up buying the real estate, if you have enough of that real estate, eventually you're going to find yourself not paying any taxes. If you're doing what they incentivize you to do, it's just an incentive. It's not like anyone's being illegal. I mean, some people are. Some people are tax evaders, but the people that people get mad at, like Donald Trump, Elon Musk. I think Elon Musk did pay taxes recently, but people like them, they own. We're talking about assets and liabilities. Their money doesn't come from active income. They don't have jobs.
Yes.
They own companies and they own assets, and then they take out loans against those assets, which are tax free. You can't tax a loan. It would be like Steven giving me a mortgage for my house and the government or the IRS saying, "Hey, I saw you took out a mortgage. We need some, a cut of that." Like, it doesn't work like that.
Yeah.
It's a loan. And then the other way they make money, besides taking loans out against their assets, is the cash flow. You can't really tax cash flow because of the way the tax code is set up. And the other thing I'll say about that is, if you do the things that you're incentivized to do to where you wouldn't pay taxes, you're actually doing something better for the economy than paying taxes, because you're creating a shit ton of jobs, creating so many jobs by just buying real estate. It's crazy. I forget the actual numbers, but if you think about, especially if you're like going in and flipping a house, that's one of the best things you could ever do. Like, you're giving someone a house.
Yeah.
You're giving a job to a contractor. It's not.
And you're also cleaning up the street. If
Yes.
there's a house that, their neighbors, I'm sure, probably more happy than anybody else that someone's going to come in and make their neighborhood a little bit nicer.
Yeah. Yeah. So it's crazy. Like, you create jobs, and then you're incentivized to do that, and then you don't have to pay taxes. So I don't know what people are mad at.
Yeah. Yep. No, 100%. I definitely agree with that. Yeah, a lot of people do get mad at the rich for not paying taxes, but why don't you just start doing your taxes like a rich man?
Do what they do.
Yeah.
There's two different mindsets. It's like, man, it's not fair. Rich people are rich, and the rich keep getting richer, and the poor keep getting poorer, so I'm just going to complain about it. And the other mindset is, wow, the rich are getting richer and the poor are getting poorer. How do I become rich?
Yep, 100%. And it's not like you're gonna have some big awakening today and be like, hey, for my taxes for 2022, I'm gonna file it this way. No, you have to. It's a preparation.
Yeah.
So like the way you spend your money in 2023 will determine how you get to write off your taxes. In 2024 for this
Right.
year. So plan ahead. Make sure that you're buying maybe an investment property to write something off, for that next tax season.
Right. And that's why that's why it's called a tax strategist. Like, you've got to sit down with these people and they'll make a plan for you. Like, I've got a financial advisor that I'll plug. I'll put them in my description as well, but they'll make you an entire plan and sit down with you and explain to you how everything works. And a lot of it probably going to go over your head, goes over my head for sure. There's a lot of stuff I don't understand about taxes, but these people went to school for it. They're trained in it. They actually understand the tax code. And if you're with the right guy, he understands investing in real estate as well, and he understands how you're incentivized to buy real estate to save you on taxes, and sometimes even skip out on taxes as an investor. So that's why it's really important to sit down with people like that who understand the game, and they can help you out with that and make an actual plan for you.
Yeah, definitely. And a big thing too is, like we were saying, some of the most wealthy people, some of the people who are making the most income, don't show that on their taxes. And so when they're going to buy a house, not an investment property, not something for a DSCR loan, a great option for them is a bank statement program, which is something we offer where you come to me, prove that you've been in business for 2 years. We take 12 to 24 months worth of your bank statements, calculate your cash flow, and use your cash flow as income instead of needing tax returns, pay stubs, or anything.
Do you
like
have to
that.
have consistent monthly cash flow, or is it just I've made this much money last year and it averages out to this much per month?
Correct. So they, I have had a borrower come in, submit their bank statements, and had a few cents this month, a few cents that month, and then $100,000, a few cents, a few cents, a big
$300,000.
And it's and I was like, man, where's this all coming from? And he's like, well, I'm a contractor, so I don't make money for months.
Yeah.
And then the home will close, and I'll get a large sum of money,
Right.
and then I'll go a few more months until the next house is finished and completed. Then I get paid again. So yeah, there are definitely situations where you don't need to have consistent cash flow.
Yeah.
As long as it's enough to average over that.
Right. No, that makes sense. I got you. Okay. So the way so explain that again. So with the bank statement program, you're proving that you're running a profitable business and you calculate the cash flow, and then do you use the cash flow as if it was income?
Yes, not 100% of it.
Okay.
And there's a calculation behind it, and they don't go through like every single expense that you have, but they go through the bank statements, look at your deposits,
Mm.
and then based off of the type of business you're in, stuff like that, they'll let you use a certain percentage of that cash flow.
Okay. What's the normal? Would it just be traditional like 20% down if I was gonna buy it for an asset for a rental property?
Yes.
But it'd be 20% down for a bank statement. If it was personal property, would it be like 10%?
Yeah. So any bank statement that you're gonna live in, like bank statement loan for your primary residence, is 10% down. They actually have 10% down, no mortgage insurance. So a lot of
That's
really,
nice.
yeah. So there is definitely some plus sides to those bank statement programs.
Gotcha. So is that one that you would recommend, or is that mainly for people who are find themselves in an issue where they can't show income?
Yeah, I would definitely. That's a last resort for primarily self-employed borrowers who aren't showing that income
Yeah.
on their
So
taxes.
contractors, 1099 people.
Yeah, I mean, real estate agents, loan
Yeah,
officers, people who aren't W-2'd.
Okay. So you own a house, huh?
Yep.
What was your loan? I'm just curious.
We started off with an FHA.
Is your wife W-2?
Yes, my wife is W-2.
Okay.
And I was actually W-2'd at the time as well.
Oh, really?
Yes. But she bought it actually by herself. My
Really?
sugar mama, yeah.
Sugar mom.
But no, yeah, she bought the house FHA loan. And when I got in the mortgage business, I came home one day and said, "Hey, we can refinance today at 2.25." And so we switched to a conventional loan. We still have mortgage insurance, but
Are you able to do your own loans?
no, I wasn't able. My boss had to do
I
it
got
for
you.
me.
I got you. Conflict of interest, I guess.
Yeah, something like that.
All right. Anything else you want to talk about before we wrap up?
I think we covered a good bit of stuff today.
I think we did. So what's the best loan? We'll end with that. If I was able to qualify for it, conventional loan is the best, huh?
Yes,
Okay,
by far.
for rental properties.
For rental properties, for primary residents, I think across the board, conventional is without a doubt the best program.
And those close a higher percentage of the time. Is that right? Or not really?
I think so. For me personally, a majority of my clients are FHA.
Okay.
And that's just usually because lower credit score, not over 680, and they want to go much higher than conventional will allow. So FHA allows you to purchase the most, have the highest approval. Conventional though, the best part about conventional is mortgage insurance falls off when you get to 80% loan to value. So once you've paid off 20% of your loan, mortgage insurance falls off. You don't have to refinance and do all that. But with every other loan product, you will have mortgage insurance for the life of that loan, except for VA, which never has it.
So it sounds like the tier for investing is conventional if you can, and then DSCR if you can't, and then bank statement if you can't do that. And then as long as you're actually
Yeah.
making cash flow, you should qualify for one or more of those.
Yeah, absolutely. I mean, especially if it's already has a tenant in the property where you can use that rental income right off of the bat.
Yeah. Yeah. Oh, that's real nice. Then would you even have to have it appraised?
No, so for it, well,
If
for the
there's already
DSC,
an-
for the
a
DSCR, yes.
You would still have to have it appraised and make sure that the tenant's paying market value rent.
Correct, and they're not overpaying or anything like that. And that if this tenant was to, unfortunately, I don't hope it doesn't ever happen, but if your tenant were to die or you know, and you don't have that, you need to refill that spot.
Yeah.
They want to make sure it's a.
Or if they just stop paying rent one day.
Or if they, hopefully there's no. I can't remember even what they called it, but you couldn't kick out your tenants during COVID.
Oh my god, yeah, and they just stopped. They were like, all right, guys, you don't have to pay your landlords anymore. Just
no, you don't pay me. But no, yeah. So that's one thing too, is when you're getting into an investment, everything is a risk. And if it wasn't a risk, everyone would do it. So that's something you always do have to remember.
Yeah. All right, so why don't you just plug yourself real quick? What company are you with? And I guess tell them about website if you have one and where they can contact you. Maybe social media too if you want.
Yeah, no, absolutely. If you go to ReliantApproval.com, that is our company's website. We are based out of New Orleans, Reliant Mortgage. And for social media, we'll put some links in the video.
Okay.
Because they're gonna be hard to. They got underscores and this, that, and the other. So
that's annoying.
yeah, I know.
All right. Everything's gonna be in the description below. But yeah. All right. Any last thoughts or anything?
No, I think that's it. Hopefully, we'll get you on the home this year.
Yes, sir. All right. Everyone, have a great rest of your day. All right. That was pretty good.